the real point is the higher they revalue gold to, the higher the level they value it at, the more profit they can make, the more money which can be printed without increasing the level of government debt. Because when they revalue gold, effectively the net result is the Federal Reserve will end up with this thing called gold certificates, which is not part of the USA debt.
Can stand up and say gold should be 100,000. It's not going to trade 100,000 tomorrow. If you have a big institution like a government, a Fed that actually engages in the market and says almost on a bottomless basis, we will give you treasuries to the value or dollars to the value at 20,000. Then you have a buyer and now you have volume. Can stand up and say gold should be 100,000. It's not going to trade 100,000 tomorrow. If you have a big institution like a government, a Fed that actually engages in the market and says almost on a bottomless basis, we will give you treasuries to the value or dollars to the value at 20,000. Then you have a buyer and now you have volume.
Financial analyst Clive Thompson has outlined a compelling strategy regarding potential Federal Reserve gold revaluation, centering on the significant disparity between current statutory pricing and market values. The United States maintains gold reserves valued at $42 per ounce, while spot prices trade near $3,300, creating what Thompson views as an underutilized fiscal resource. Thompson's analysis references an August 1st Federal Reserve publication that specifically cites $3,300 per ounce as an example price point, suggesting institutional consideration of revaluation scenarios. His framework proposes that marking gold reserves to market prices could unlock substantial fiscal capacity without requiring traditional debt expansion or congressional approval, as higher revaluation rates would generate paper profits supporting expanded money creation through existing Federal Reserve mechanisms. Recent market developments appear to align with Thompson's analytical framework. A proposed 39% tariff on gold bars exceeding 100 ounces would prevent speculators from exploiting price differentials between international markets and a domestically revalued gold price of around $3,200 per ounce. This tariff structure targets institutional traders while preserving retail market access, creating controlled conditions for potential revaluation. The strategy leverages existing institutional mechanisms rather than creating new policy frameworks. By utilizing government gold reserves as a fiscal tool, Thompson's approach addresses contemporary debt constraints while operating within established Federal Reserve procedures for the creation of money and the valuation of assets. This video examines how the Fed could revalue gold by creating new money, reducing debt in the process. Subscribe for weekly, data-driven insights that shape our ongoing market analysis.
No certainty that the Fed will choose a figure of 15,000. They might just choose, if they do it at all, the spot price. And in fact, there's a small indication that that might be under consideration because of the publication by the Federal Reserve on the 1st of August about gold revaluation and how other countries have accounted for it. And in that particular paper, they discussed revaluing gold to 3,300, which was the price on the day they did it. So first of all, 15,000 is not written in stone, but the real point is the higher they revalue gold to, the higher the level they value it at, the more profit they can make, the more money which can be printed without increasing the level of government debt. Because when they revalue gold, effectively the net result is the Federal Reserve will end up with this thing called gold certificates, which is not part of the USA debt, doesn't have any interest, and has no maturity date. So what they're basically doing, if they do a revaluation at any level, they are swapping the debt that they have at the moment, or some of it, for gold certificates, which is not debt according to the official, the Treasury balance sheet. Now, as I said, the higher the price they do it, the better it is. So I picked a figure out of the air of 15,000. I kind of felt my figure was on the low level compared with some other people who've been picking 20,000. But of course, the level at which they'll do it, if they do it at all, would be at what level do they dare to do it without disrupting the market? Because we don't want they don't want to do a figure which is going to make people panic and say, oh my God, the dollar's worthless because they've done this. So I kind of chose that number based on what I thought would be a right number relative to the amount of money they've been printing in the past. As you know, they're printing roughly $2 trillion a year effectively in new debt to pay for the budget deficit. So the figure I picked of $15,000 would cause a new printing of 3.9 trillion as opposed to the 2 trillion a year which is being created. So that would be very, very slightly inflationary. Not much. I mean, let's face it. With the amount of money which has been coming into existence over the years, it's not a big deal. For example, it's only about 10% of the national debt, so it's not a really big deal. So I'm looking at the question. He said, if Clive is correct, if gold is revalued to 15,000, what happens to the US bill note and bond markets over the next couple of years? Well, first of all, what happens to the bond markets? I think the immediate reaction is that it's positive for bonds because if they do this, they don't need to step into the market borrowing quite as much money as they needed to. Therefore, the natural buyers of bonds, who would be naturally in there buying the bonds, won't have those new bonds being issued. They won't be available for a very short period. So that should be positive for the bond markets. It won't affect the T-bill market at all. And I don't think retail prices are going to be affected in the slightest because retail prices are not linked to the gold price. Francis, what do you think of all that? When I buy physical metals, I tend to think that I'm not buying them with a plan to sell tomorrow or next week or next year or 5 years or 10 years or at any price. It's kind of like the parachute you've got just in case the worst comes to the worst and you've got no choice. But if you want to trade in and out of gold and silver, then the way to do it is the way I know you don't like it, Mario, but the way to do it is through ETFs or gold mining shares or things on the stock market where you can trade with a very narrow spread and at high speed. But that's a completely different kettle of fish from having a parachute. Trading is where you buy something with a plan to sell it quickly and make a profit. Whereas I think the reason why a lot of people are choosing to buy gold these days is because they fear that the financial system that we are in is getting close to the end. I fear the trust in fiat money could evaporate very quickly, and then they might be forced into a new system. And if you own a gold coin before we cross that line, you'll still own it afterwards. Whereas if you've got something in custody, subject to the whims of a third party, you're not sure where you're going to stand. You're not sure if they're going to take it from you. What you're waiting for is a breakout in one direction or the other. Now, more often than not, when that happens, it's a breakout to the upside. But the thing to watch is when it does break out, that's when the big move is coming in the direction that it does break out. So I'm hoping for everybody who's listening here that it will break out to the upside, and that's where the probability lies. It's more likely to do that than go down. But of course, you never have any certainty in life with these things. But it looks positive to me, and I think with everything we're hearing about what's going on in the world, I give you a small example. I've just done an exercise which I published on LinkedIn today about the interest on the national debt as a percentage of their tax take. 3 years ago, the interest cost to the government was about 10% of what they collected in taxes. This year, according to my calculations, and it's pretty close to this Congressional Budget Office's calculation, but I'm slightly worse. They say 18.5%. My calculation is that the interest on the national debt this year, 2025, will be just over 20% of what they collect in taxes. So basically, it's doubled from 10% of what they collect in taxes to 20% in just 3 years. And that direction of travel is going to carry on. So we're, on that metric alone, things are starting to spiral out of control unless something very dramatic happens. Either there's a lot more taxes collected, or there's a lot less expenditure, or they revalue gold at a sufficiently high level to get rid of that huge deficit which is running up, or they think of some other miracle plan to resolve the debt situation. And I don't know, there are other things out there. Maybe they can get the banks to do a bail-in or force them to buy more treasuries. But things are getting into dangerous territory. Yeah, one thing which might solve this would be a massive reduction in the yields on 5 and 10 and 20 and 30-year treasuries. If those yields were to come down, and don't forget those yields are not within the control of the Federal Reserve, but if those yields were to come down, that might help things. But at the moment, the Congressional Budget Office is forecasting an interest rate of about 3.1% for 2025. I think it's going to be a little bit higher than that. And I think that next year it's going to be higher still, and the year after higher still, all because they got this huge quantity of debt maturing. at 1 to 2%, which will have to be refreshed. And it's, even today, you buy a 10-year, 4.2%. That's a lot higher than the 1 to 2% yield, or not yield, interest rate, which is being paid on the debt they took out over the last decade. So I think we could have a credit crunch at short order. I'm not saying next week or next month, but at some point, people are going to say, we're not taking any more government debt because the interest cost is just getting too high as a percentage of everything.
Veteran analyst Francis Hunt argues that central banks deliberately maintain gold's official valuation of $42.22 to avoid highlighting systematic dollar debasement. Hunt notes that this price has remained fixed for 54 years, despite market rates near $3,300, creating what he views as an intentional policy blind spot that obscures currency depreciation. Hunt's analysis reveals that the dollar has declined at an average annual rate of 8.4% over the past 5 decades, with a recent acceleration tied to expanding debt and the 2020 bond market crash. The US dollar ended the first half of 2025 with its most significant loss since 1973, as the dollar index fell approximately 11% from January through the end of June. This performance represents the most substantial decline in the first half of the year in over 5 decades, reinforcing Hunt's thesis about accelerating currency debasement. Market dynamics support Hunt's concerns about unwanted attention to gold. While the dollar recovered 3.2% in July, Morgan Stanley Research expects the decline to continue, possibly adding another 10% in losses by the end of next year. This forecast aligns with Hunt's argument that central bankers prefer to avoid mechanisms that would draw focus to gold as an alternative store of value during periods of currency weakness. The strategic dilemma Hunt identifies centers on competing priorities. While gold revaluation would provide fiscal benefits, it would simultaneously quantify dollar weakness in transparent terms. Let's get back to the video.
In terms of this reval discussion, I've got a couple of quick-fire thoughts that I thought everyone should do. There's a massive difference between mark to marking. We've had 54 years without marking to market. We're at $42.22. And that actually would have very close to zero, although minor bullish, because it's going to drag gold into the spotlight again. And it's my overall assessment that central bankers love to ignore gold. And the last thing they want is retail and media overly focusing on gold, because gold is the canary in the proverbial gold mine, if we can. And in the 54 years, the dollar debasement, which means actually the gold appreciation, these things are totally synonymous when I use the dollar debasement and gold, because gold is the benchmark that we assess its debasement by, has actually seen the dollar lose in those 54 years on average compounded 8.4%. And I will tell you that in the last 5, since COVID particularly, in actual fact, disproportionate of that 8.4% would be happening now. So an average is again misleading, a la my ice bucket and fire bucket analogy. You're actually getting the acceleration parabola now in terms of loss of valuation. And that's come on the splurge of debt with our 2020 crash call on the bond market. And with the bond market crashing, you've got to treat the dollar and the treasuries or T-bills, the short or the long-term variety, as almost synonymous. You get step debasement of both. So an acknowledgement that if you do a mark to market, that means you accept the current price discovery mechanism and you move the gold price to there. There is no derivative immediate effect, I would say. Anything that involves a multiple, and Clive's example to 15, and he was the most conservative in fairness to Clive. George was at 20 and others were at 20. So he wasn't going all, Max Kaiser 1 million Bitcoin out of everybody else. I do think it's a clickbaity title because there's a bit of hopium that it instills in precious metals people that I don't think will truly transpire. Because if you did a gap of 4.5 times the gold price to 20,000, let's take on the other guys apart from Clive, who was the most conservative in that. But you're still, even at 15, talking a big multiple. You're instantly blowing up, I'd imagine, a lot of derivatives straight off the cuff to organize something like that didn't destroy the banking system. So then if I say that, some people will say, well, maybe they're planning to destroy the banking system because everything's now going to be, a digital system and go just to central banks. I then remind everybody that those banks that have those derivatives were probably doing that serving the central banks and are the primary shareholders of said central banks. So it's a bit like the dog voting to have his own tail cut off, or vice versa. If you treat the central banks as the tail, it's a bit like the dog voting for his tail to be cut off. And the head represents actually the bank. It's part of the same mechanism. So to pass a huge loss, then there's the other thing, it would be a temporary measure. They're going to come back and do it. They would have to do it again. The level of derivative overhang in manipulation was largely not what it is today, is my assertion. In other words, there was less likely to have repercussions. So again, I'm differentiating 70s to today. I'm saying, I think we have something that resembles that. And it's going to be a contained bull run, and they're going to need ever more access to ability to borrow. So they're going to dip into that newfound, call it an overdraft, but it's quickly, once it's used, it's used. Then they're going to need it again. But to do the hyper over the decree, would also require government to actually buy at that level to be meaningful as a price. Otherwise, we ignore it. I mean, I can stand up and say gold should be 100,000. It's not going to trade 100,000 tomorrow. If you have a big institution like a government, a Fed that actually engages in the market and says almost on a bottomless basis, we will give you treasuries to the value or dollars to the value at 20,000, then you have a buyer and now you have volume. And because of arbitrage, all the other exchanges would fall in line, providing that it tested and met the criteria that they're going to keep shoveling. We are looking at a global communism and totalitarianism to make everybody reliant on UBI, as large a segment of the population as possible, so that you ultimately control them. If you control the food supply and you control how they earn and what they can eat, you have the end goal that I believe these people have always sought. So the lottery hope of a 4x, 5x, 6x on gold that will benefit quite a reasonable sway. Now, as we say, hedge funds don't really have a lot of gold, but there is still in the liberty movement quite a high tendency to stack gold and silver, that their greatest enemies, and believe you me, libertarian people who seek self-reliance are invariably the biggest enemies of a totalitarian state who's seeking a great leveling in the Western markets. You are not likely to get this lottery ticket. And I don't want to be the guy behind hopium on this for a number of reasons. However, truth does out, and I think the option of a mark to market is far more likely, and the force of necessity and the inflation that they're going to be generating could see Nixon-esque regular mark to markets to open up the overdraft out of force of necessity, which probably means they'll go either for a similar confiscation or other aspect, which is a bit draconian, but depends how totalitarian we get. We're being told a lot what to do, but they can also do their unrealized capital gains, which is what probably my primary scenario, where they can enforce sales by instituting an unrealized capital gain on you. So they want to know what you have, so you're going to have to blockchain it. I would suggest maybe having some gray or black gold, which would be off-grid, illegal, and probably punishable by death, given that they're the Marxists that they are. And you probably will face capital gains tax even if you have not sold, just by virtue as they know we're patient stackers. That's how they have a plan for gold and silver, guys. Without a doubt. And they aren't going to enrich us without a clawback or an attack vector. And it's not good news for me to say that. Don't shoot the messenger. I'm just very clear about what history tells us about the kind of people we're dealing with. They do the revals after they've stripped you out. And if they're not going to be able to get away with doing that now, they're going to make sure they get their pound of flesh out of you, the Shylocks that they are. So that's my take for the question. We've got to watch for those attack vectors if they do end up giving you a decreed new price that isn't price discovery. There's a lot of legalese that will have to be negotiated. I don't believe they'll be prepared to bankrupt the banks, their shareholders. And I don't think it's a high probability, and don't get sold on hope, because then you don't get the crash of the disappointment. Mark to market is far more feasible. And I think it could regularly be mark to market, because once they do it once, it becomes the tap that they keep dribbling the drops out of and getting sustenance. So it could be repeat. And I think you should keep doubling down and keep giving them back their fiat and keep stacking. And you should have locality optionality so that you don't get taxed out of your metals. And that's what we do for our community very specifically, because it's not just what you make, it's what you get to keep.
Mario Innecco, founder of Innecco64, argues that gold serves primarily as protection against currency debasement rather than for administrative revaluation. However, he believes that marking gold to current market levels, around $3,400, could trigger price appreciation to $5,000 to $6,000 within a year, similar to the 1970s monetary upheaval. Innecco's analysis gains relevance when examining China's strategic gold accumulation. While official data shows that China's reserves increased to 2,298.53 tons in Q2 2025 from 2,292.31 tons in Q1, Innecco notes that analysts believe China's actual reserves could exceed 30,000 tons, dramatically surpassing the officially reported figures. This discrepancy suggests China has quietly accumulated gold for years, positioning itself for a stronger role in future gold-backed monetary systems. The strategic implications become clearer in the context of broader de-dollarization efforts. China's central bank has been buying physical gold for at least 3 years, with growing speculation about additional secret purchases aimed at reducing its reliance on the dollar. This covert approach serves multiple purposes, maintaining price stability during accumulation while preventing speculation that could drive prices higher before completing desired positions. Current dynamics support Innecco's thesis about China's growing influence on precious metals pricing. China's gold reserves averaged 1,237.91 tons from 2000 to 2025, reaching an official high of 2,298.53 tons in the second quarter of 2025, after a low of 395.01 tons in the same quarter of 2000. However, speculation about undisclosed reserves suggests actual accumulation may be far more dramatic than official figures indicate. Let's get back to the video.
I had a look again at this chart. I've been following these two charts very closely. So it's the German mark, the gold mark in paper marks in the 1920s, late after the war, and then the gold price in dollars. The cycle is lasting longer in dollars, but it looks looks like the same to me. And this is a monthly chart. So if we look at the monthly chart, the spot price here looks like it's breaking out. And I saw that you spoke about, Francis, about the fact that you think this is being done on purpose by the powers that be to basically transfer almost all the wealth from the general public to their pockets. And the Russians, they have, Russia has not Russia, but China, some people think they've got over 30,000 tons and not 2,300. The reason why we hold gold is not for revaluation, is because it's a protection against debasement. But I think if they revalued to the market, like 3,400, where we're now roughly, we would see gold go to 5,000, 6,000 in the next year, just like it moved here in the 7th. I interviewed an Italian guy a few weeks ago. His name was Andrea Cecchi, and he thinks that the confiscation will be done via allowing the gold price to like skyrocket. He used 20,000 or even 40,000, I don't know, as a revaluation. And he said that will play into people's greed, and they will sell their gold for fiat, which is worthless. And then the government will get, and the bankers will get all the gold. So that's the way. I actually agree with Andrea Cecchi. Or they could also take it from the GLD. The ETFs have a lot of gold, and it's a lot easier to take it from the GLD than go around every American that has gold. And I don't think many Americans have gold in terms of a percentage of the population. So I actually had this article here to show the viewers and you guys, because they're thinking of now accessing, well, they are going to do this from April 2027. the taxman will be able to access your savings accounts, your bank accounts, to see if you're earning interest, and they're going to tax you directly. The other thing I would say about capital gains, there are, and I'm not like saying that I don't agree with Francis. Yeah, it's good to have optionality. My father, we grew up in Brazil, and when things were getting really bad, he got his Italian passport because his granddad was Italian, and we all got it. And that's one of the ways I was able to go and live in Switzerland and come live here. So I'm aware of that. But there are ways here in the UK still to protect yourself. I know it's getting harder and harder, but in terms of capital gains here, gold and silver, if you buy coins of the realm, there is no capital gains tax. The other thing that I've been doing, Francis, is because I invest in the gold and silver miners. And for the last 3 years, I've been putting as much as I can in the tax-free ISAs. And it actually adds up, and they might change that, but they can't go back and change it. So there are ways about it. And the other thing that not everyone can do in the UK, if you are like self-employed and your business is improving, you should think about creating a limited company and becoming the employee of that company and paying yourself the least amount of wages or salary as possible. And then there are ways to pay yourself dividends. I'm not an accountant and tax advisor, but I think there are ways about it. And one downside, Francis, about having optionality. You never really know when you go to another country what's going to happen there too. Like I saw that Italy, they welcomed a few years ago billionaires, I think more like it, or very wealthy people, and they said you're only going to pay maximum 100,000 euros tax a year. So for someone who pays millions a year, that was good. But now they've changed it to 200,000. So I think you've got to be careful, but I agree with you. You need to have options. You need to keep stacking and holding to your gold and silver. This is more like for trading. It might help you with your miners as well, because if gold's doing well, the miners are going to continue to do well. And we didn't even touch upon the fact that miners are still very much undervalued, I would say, versus gold. So I think there's a lot of opportunity there too.
Any move to revalue gold, whether at the spot price or a substantial multiple, would carry significant implications for monetary policy, debt management, and market stability. At the same time, a moderate adjustment could draw renewed attention to gold's role as a benchmark for currency strength. A sharp revaluation, however, risks disrupting derivatives markets and undermining confidence in the financial system. The scale and execution of such a change would ultimately determine whether it acts as a controlled measure to strengthen government finances or trigger wider economic and systemic consequences. Stay tuned for more data-driven insights into the shifting financial landscape. If you appreciate grounded, fact-based analysis, remember to like and subscribe so you never miss our weekly updates. I appreciate your support and enjoy the video.